I'm Stan Barnes, and I'm here with Eddie Hatch, and we're Barnes Capital Group. Welcome to the 5th edition of Barnes Quarterly. We're here in the fourth quarter, closing in on the end of the year and entering the holiday season. We're hopeful that you and your families will get a chance to gather and enjoy the upcoming season. We think we've got a great lineup of guests for you today. We're going to start off with Michael Kalifeh, who's a partner at Howell Ferguson, a local accounting firm, who's going to talk about year-end tax tips, followed by a regular on the show. That's Chris Zaccarelli, who's our portfolio manager up in Davidson, North Carolina, who will talk a little bit about the market events and what to look for going into 2020. And then finally, our spotlight on local not-for-profits. We're going to be featuring Donald Parks, who's the executive director of Good News Outreach.
We've got a couple of updates this quarter. We have been getting several questions from clients who've driven by our office and seen the for sale sign in the front yard. We will be making a move this coming March. We are going to be moving into the Hermitage Center, which is the State Board of Administration building on Hermitage Boulevard in between Thomasville Road and Capitol Circle. We think that's going to be a great space for us moving forward and look forward to the move.
You know, generally, as we approach the holidays, a lot of people are focused on football and the upcoming playoffs. And Eddie, why don't you give us an update on what's been going on in that realm, both here at FSU and maybe on a more broader scale?
Well, I'm happy to say that Georgia is currently not in the top 4, and hopefully will continue to stay that way.
The last quarterly, we were talking about how FSU seemed to be turning the corner, and obviously there have been quite a few events going on here with Coach Taggart departing and hopes of who his successor might be. But the team seems to be doing well under Coach Odell Haggins, and we're certainly happy to see that.
I'll be over in Gainesville for the UF-FSU game, attending the festivities, and hopefully as a Florida fan it'll work out okay. Stan, I know you got to spend some time out of the office. You want to tell us a little bit about your trip?
So I had the opportunity to enjoy a couple of days out in Twin Bridges, Montana with some friends from Tallahassee, and I just wanted to give a shout out to Rack and Reel Outfitters, Bo Bradley, Ryan, and the whole crew. It's a beautiful place and a great organization. If you have any interest in hunting or fishing, they're a great group to contact. So we're happy to have Michael Kalifeh, who's a partner with Howell Ferguson, a local CPA firm. And we just thought it might be helpful to have Michael outline maybe some tax planning ideas before we get here to the year end, and maybe offer some things to think about in your tax planning going into 2020. So Michael, what comes to mind off the top of your head?
So anytime we talk about tax planning or tax savings opportunities, most of the time it means that you have to spend $1 to get a tax benefit. And so anytime you can move money from one pocket to the other and get the tax benefit, we want to focus on those things first, because you keep the dollar and you get the tax benefit. So most commonly, clients of ours utilize that opportunity through retirement vehicles. It could be through a traditional IRA, it could be through a Roth IRA, or for our small business or business clients, it could be through a qualified retirement plan like a 401k or another retirement vehicle such as a simple IRA or a SEP IRA.
And those amounts, those allowable amounts that you can contribute are typically indexed from year to year. And so didn't we get another bump in 2019? Where are we on that now?
So they vary, but the IRS did just release a adjustment upward to those contribution limits, but those will be effective for tax year 2020.
Okay. So for 2019, the limit for an individual was $6,000 if you're under the age of 50, and $7,000 if you are 50 or older.
With respect to both traditional and Roth IRAs, that's correct.
Okay. What other things would you be thinking about?
Yeah, so focusing just for a minute on the business taxpayers, most all of those opportunities when you're talking about, again, spending a dollar to save on taxes, if we're not moving it from one pocket to the other, we want to spend dollars where we were going to spend those dollars anyway. So it never makes sense to spend a dollar to get back 20 to 30 cents from the government where you economically then have a net 80 or 70 cents on the dollar. So we focus on, most commonly with business taxpayers, equipment, fixed asset type purchases. Those could be computers, vehicles, equipment of all types depending upon your business, where the current tax law allows for, in many cases, immediate expensing of those assets where you can write the cost of those items off all in the year of purchase.
And what about going into 2020? Are there any new laws or new provisions that we didn't see in 2019?
For the most part, no. The big change in the tax law first implemented in tax year 2018. So the Tax Cuts and Jobs Act was first in effect for tax year 2018. Now that we have stability, assuming no further changes from Congress, we'll have stability in that environment for the next 7 to 8 years. We have new interpretations coming out routinely from the IRS, and more to follow from the judicial system as to what some of those laws mean. But for now, we have some continuity in the tax law, which is helpful for planning.
Do you think, I know I've heard a couple of people say that maybe there were some unintended consequences in the new tax laws that went into effect. Did you see much of that with your clients?
Yes, a lot of that is depending upon what side of the table you sit on. So I think that the overall premise behind tax reform is there was an attempt to make it more simpler or more efficient. And in doing that, where there were cuts made to the tax code, there were also revenue raisers to help balance it from a budget perspective from the federal government side. So one of the provisions that was removed as a fully non-deductible was contributions made for seating preference or ticket preferences to athletic events. And this has largely hit the collegiate or university college level. It's hit our local Florida State Seminole boosters. It's hit universities across the country in a similar way. And so unintended is probably not the right word, but it has been an adverse impact to our clients and taxpayers who are looking to support their respective universities and colleges at the athletic level.
What about other, like, not-for-profits and that sort of thing? Have you seen any changes there in terms of?
No, because there's been no real meaningful change in the deductibility of charitable contributions to 501c3s in general. It's largely with seating preferences and ticket preferences at athletic events. We are seeing some discussion from individual taxpayers about making charitable contributions because the standard deduction was doubled under the new tax reform package for a married couple filing joint to $24,000 versus the $12,000 it was before. So you have to have many more itemized deductions or charitable contributions, as an example, before you begin to take advantage of those deductions under the current law.
Well, since we're kind of in the giving season when people are thinking about these kind of contributions, I think that's helpful information to know. Well, I really thank you for being here today, and always appreciate your expertise, and we hopefully will be able to count on you to come back again before too long.
Happy to do so. Thanks for having me.
Well, I'd like to welcome Chris Zaccarelli, who's been a regular visitor with us on Barnes Quarterly. And we're closing in on the end of a year, and it's been, I think, Chris, you might characterize it as a good year in the market this year, and just kind of wanted to talk about maybe some of the items that are in the news and what we see going forward into 2020.
Well, as far as the market this year for 2019, obviously it's been a great year in the market. We've had a really nice bounce back from last year where we had such a disappointing fourth quarter. And really, I think the bounce back we've seen this year is a realization that a lot of what we saw last year was unwarranted fears. There was a concern that we were going to go into a global recession. There was concerns that the U.S. was going to follow that path down the rest of the world. And so far, that's not been the case. We've continued to see economic data that's good, not great. The economy isn't booming by any means, but the economy is chugging along at a pretty sustainable pace. We're really in a not too hot, not too cold environment. And because of that, stocks have recovered back to all-time highs. and continue to move forward, mostly with an earnings rebound, but also the realization that we're getting closer to some type of resolution with China. And really the big themes that we saw for last year, whether that was the trade war with China, the Federal Reserve Bank and their interest rate policy, and just the global economy, a lot of those concerns from last year have started to resolve. The trade war with China is definitely ongoing. We still have outstanding concerns about how that will resolve. But it seems like both China and the U.S. have come to the realization that at the very least, a truce would be good for both countries, and they may need to just find some areas where they agree to disagree. So some type of cessation of hostilities between the two countries, specifically as we approach December and, a potential increase in tariffs. If that can go away, I think the markets can continue to move higher. Unlike last year where the Federal Reserve raised interest rates four times, this year the Federal Reserve has cut rates 3 times and indicated that they're mostly going to move to the sidelines. So from a central bank point of view, things are actually much better this year than last year. And then finally, as regards to the global economy, things were headed in a negative direction last year globally, although the U.S. seemed to remain immune from that. This year, the U.S. has slowed a little bit, but continued to be steady, and it looks like the rest of the world may be hitting bottom and starting to climb back higher. So all things being equal, I say 2 of those 3 issues are better this year than last year, and that third issue, trade, still remains unresolved. But I do believe we're getting closer to some resolution, even though it'll be a shorter resolution, a smaller resolution, and a less large deal than we had originally forecast. Breaking it up into pieces, I think, is a game changer.
I know I've had some clients call that are getting a little bit edgy as the media is sort of highlighting the fact that we're hitting new market highs on a daily basis, or at least we were over the past month or so. And they have actually made the decision to sort of shift some of their funds from the stock market to fixed income. And just, I guess if you would comment, what should an investor be thinking about who may have new money to put to work or may have money in the market right now in terms of their asset allocations? Would you be recommending any sort of changes given where the market is and given what we're facing in 2020?
I think, the market continuing to hit all-time highs, are both a factor of some of those risk factors starting to lessen, as well as the fact that it's been yet another year. Year to date, we've had a really large market move. But again, that's mostly undoing a lot of the damage that we saw from fourth quarter of last year. Even if you look at September 30th, 2018 to September 30th, 2019, the market only moved about 2% higher. So there hasn't been this massive move higher year over year. What we had was that big sell-off, which is probably unwarranted into December, and a really big bounce back from that sell-off as people realized things weren't as bad as they first feared. So I would say, yes, the market's at all-time highs, but I would caution that I don't feel like the market has really gotten ahead of itself. Going forward, I do think right now, again, because the market has gotten back to all-time highs, it's always a great time to reevaluate your risk tolerance, but especially when the market's at all-time highs, that's when you want to make your moves. When the market's sold off, it's very difficult to make changes and lock in losses. But when the market is back to all-time highs, it's a great time to look at your risk tolerance. If you've got a shorter-term horizon, you're expecting more current income, maybe your risk tolerance isn't as high as you thought, it's a great time to reevaluate, and that's when it would make sense to move from stocks to bonds. But purely looking at what's happening with the economy, what's happening geopolitically, I would not get so concerned about what's going to happen next year. I think, markets will do what they're going to do. It's very unpredictable. We could easily have a huge up market next year if trade resolves, political uncertainty gets resolved in a way that's market friendly, and you would be really missing out if the market took off next year. That's a very plausible scenario that could easily happen. However, on the other hand, if trade tensions increase, or if we end up with a candidate for president that's market unfriendly, and so that's not necessarily by political party. It's much more about what your policy stance is. And so, there's candidates across the spectrum, both Democrats and Republicans, that are either very market unfriendly or that are actually fine for the markets. And for the most part, if you look back over history, regardless of which party has power of the presidency, markets have gone up and markets have gone down. I can give you a list of Democratic presidents where markets have gone up and down, and likewise with Republican presidents. It matters much more who's in control of Congress, what are the policies being put forward, and then what's their impact to corporations. So I would just caution people to not get too concerned and caught up in the short-term noise of what's happening with the presidential election or even what's happening with trade policy. But I think there's definitely a scenario where markets could go much higher, and there's a scenario where markets could go back down. And because there's no way of knowing which one will happen, that's why your equity fixed income allocation is so important. It really should be tied to your risk tolerance, your time horizon, and your income needs. And as long as you continue to rebalance back to that appropriate spot, if you let things unfold even over a shorter period of time, like 2 to 3 years, everything should work out as you'd expect. In any given month or any given week, markets can sell off either for rational reasons or irrational reasons, but it's very, very difficult to pinpoint when to get out and when to get back in. And that's why I will typically caution people against making large decisions that are at odds with what should otherwise be their normal allocation based on those factors we talked about.
What sectors or markets are you focused on putting more money into at this point? What looks good out there?
The way a lot of the various asset classes have ended up and really what we've seen on the year, whether that's the U.S. outperforming the rest of the world, whether that's large cap doing better than small cap, I think has largely reflected both the risk as well as the opportunity out there. So I think what you've seen as far as themes in terms of the U.S. continuing to be a stronger economy versus the rest of the world, that's still the case at this point, but based on valuation, it's definitely worth having a look at international for 2 reasons. One, because the valuation gap is now larger than it's been in recent memory. So even though I do agree that the U.S., all things being equal, has an advantage over the rest of the world, I do think it makes sense to look at international and emerging markets a little bit harder right now because of the valuation gap and the opportunity for that to reverse. Secondly, international makes some sense because of the dollar. The dollar has been very strong. It's completely rational why the dollar has been so strong, because our economy has really outpaced the rest of the world, and because all things being equal, our interest rates have been higher than the rest of the world. I think there's an opportunity for that dynamic to reverse. So if the dollar were to start to weaken because the rest of the world starts to improve in terms of their economy, or the rest of the world starts to normalize their interest rates and move away from that negative interest rate experiment, which I think is becoming more and more out of favor, at least as you listen to policymakers talking. Either one of those dynamics could make international investments a little bit more attractive than U.S. Investments heading into the new year. Likewise, I would also say small caps have really been left behind during the year-to-date rally. Large caps have outperformed small caps by over 500, if not 600 basis points, so a 5 or 6% total return improvement over their equivalent large cap companies. So I think under a positive scenario where the rest of the world starts to heal, I think that could also be beneficial for risk taking and for U.S. small caps as well. So those are 2 areas I would look at as potentially contrarian thinking in terms of U.S. small caps and international investments versus what we've seen over the last few years, which is really the large cap S&P 500 really outperforming everything else.
Well, I know you had been high on the healthcare sector, and that already seems to have paid off for you. Are there other sectors that you think there are opportunities in the domestic market?
Yeah, absolutely. And I think healthcare is a great example of a sector that had been overly punished, not for irrational reasons, but people had just taken it too far. And so it was ripe for a bounce back. And I think we've seen that in recent months. I would say as you look at other sectors that were in a similar situation, the financials has really done well in terms of people realizing that interest rates won't continue to go down forever. And so that's still an area which has an opportunity for outperformance within the financial sector. Another sector that I think looks interesting is the energy sector, which has really been beaten down. And so it may be a little bit early to start moving into energy, but I do look at both financials and energy as examples similar to healthcare, where they've been really left behind during this market rally. And if we can move from bad news in those sectors to less worse news or even neutral news within those sectors, there's opportunities there.
Right. Well, you mentioned earlier that there was a pretty significant sell-off. I think it was Christmas Eve or toward the end of the year last year. And Ray Dalio, who's a pretty well-known hedge fund manager, recently came out and said he was putting $1 billion bet that there was going to be a major sell-off in the market. What do you make of that?
So I saw the headlines that Bridgewater had $1 billion bet both against the S&P 500 as well as the Euro Stocks 600, which is a similarly sized index in European stocks. And so if you go beneath the headlines and read the context of the story, they'll point out that Bridgewater runs $150 billion. So the fact that they have around 1% or less of the total assets placed into a hedge against all the rest of their longs makes me feel like it's just more prudent risk management. I don't get the feeling that they've decided that they're completely bearish on the rest of the world. I think they're just taking out some protection, which is something that a hedge fund can do. Numbers are startling because $1 billion is large by almost anyone's definition. But again, given that it's less than 1% of their fund, I wouldn't worry as much about them making a large directional call. I think they're just doing something that makes prudent sense at all-time highs. If you're a hedge fund, you have some of those tools available to you. Paying a little bit of insurance for protection on your overall large portfolio makes sense. So I think it's definitely an interesting news item, and I think it does point out that when markets are at all-time highs, it makes sense even for the largest players to maybe take some chips off the table. But for the most part, as a hedge fund, both the size of that bet as well as the fact that they're making it all is really indicative of how large the hedge fund is, and the fact that they're a hedge fund and not necessarily an ordinary investor, which will typically do well with just stocks and bonds and doesn't need to take out that type of protection.
When you put it in that perspective, 1% sounds a lot less ominous than $1 billion bet, but that sounds like media's attempt to make more headlines.
I think you're right. I think it's a much more sensational story just based on the nominal value, but reading beneath the surface, potentially not necessarily as scary as otherwise you would think.
Well, we really appreciate your time this morning, as always, your insightful comments, and we'd just like to wish you and your family up in Davidson, North Carolina, a great holiday season.
Well, thanks so much. I always appreciate the opportunity to speak with you. I hope your family and all of your clients' families have a great holiday season. Enjoy Thanksgiving and the holidays to come after that, and we'll talk to you next year.
Great. Thanks, Chris. As we did last time with Dina Strickland from Big Bend Hospice, we're trying to include not-for-profit organizations that are part of the fabric of our community that are doing good works. And we're honored to have today the Executive Director of Good News Outreach, Donald Parks, who I've known for a number of years now. Donald's the former dean of Flagler College campus here in Tallahassee, and we just thought it might be helpful to learn more about what Good News does here in our community. Donald, welcome.
Stan, thank you for having me.
Tell us a little bit about what services Good News provides and sort of what your mission is.
Our mission is to reach out to folks who are less fortunate, who have some basic needs, food, clothing, and shelter. But our overarching goal is to help people to be integrated into the mainstream of society. People are isolated for many reasons, poverty, criminal background, and other factors. And so as we reach out as a faith-based ministry, we're not only providing those basic needs, but also trying to include people to be part of the community.
And Donald, you've got essentially 4 channels where you provide assistance. How do you, well, first off, if you would kind of review what those 4 channels are, and then number 2, how do you come in contact with the people that you're helping?
So our 4 ministries essentially are: one is a traditional food pantry where citizens who are food challenged can come to our office every Thursday and pick up basic grocery needs. The second ministry is rather unique, and that is a senior ministry where we have teams of volunteer route drivers who actually go out into the community and deliver groceries to seniors on a monthly basis. And it's not just the delivery of the food that's important, it's the fact that many of these seniors may not have contact with folks, any folks really. And so when our volunteers show up, oftentimes they'll engage in conversation and just give a word of encouragement to our seniors. The third ministry is Mercy House, And Mercy House is a transition center for men who are coming out of incarceration. And obviously, there are a lot of challenges just to life in general, but when you've been out of society, incarcerated for a number of years, men need extra support, and that's what we provide at Mercy House. And then finally, we have a community, Maryland Oaks Crossing, which is a community for the working poor, essentially, people with dependent children. And so we provide safe housing to them at an affordable price. We also provide wraparound services for the parents as well as their children. We have a tutoring center which involves tutoring for the children, but also programs, spiritual programs, financial counseling, and the like to the entire family. So our goal there is to impact the parents, but particularly their children, so they can have a better lives for themselves.
So what is the source of how someone in need would find out about your organization as a resource?
Well, there's a network of nonprofits in the community, and we get referrals from other nonprofit agencies. We have a tremendous word of mouth, and we have a volunteer network. We've been around since 1986, and so we have volunteers that have worked with us for years. So word of mouth is a big reason or big means by which people come in contact with us.
Do you work through a network of churches at all? Is that?
We do. We are a faith-based organization, but we're not a religious organization, so we don't have any doctrinal requirements. We are completely inclusive to anyone. But we do have a number of churches that have provided tremendous support over the years. Good Shepherd Catholic Church, First Baptist, St. Peter's Anglican, and a number of other churches that work hand in glove with us.
Obviously, for not-for-profits, a critical area is your funding. And
yes.
Where does that come from?
Well, it comes from a variety of sources. The Beatitudes Foundation is a great supporter. We are part of CHSP, which is Community Human Services Partnership. That's funded by the city and county collectively. And then we rely on individual donations from supporters. We just finished our annual prayer breakfast, which was a big success, so that's our signature fundraising event. But basically, I go out in the community and just share the vision of good news in a very low-key way, and people have the opportunity to participate. And they may or may not participate financially, but there's certainly a number of opportunities for volunteer service. And so we just go out basically and make the case, and people have an affinity with one or more of these programs, then we invite them to participate either financially or otherwise.
One thing I thought was interesting to hear is you mentioned that you're in the process of a move and you're going to be co-locating with Freddie Branham, who runs ECHO, and I think that's really a unique decision on both your parts, and I think a good one. And just talk about that a little bit, if you would.
We're very excited about the possibilities of this co-location in partnership with ECHO. Each ministry has its own individual strengths. ECHO, for example, has professional case managers who are able to sit down and make an assessment with individual clients, hopefully helping them develop a plan which can result in the maximum amount of self-sufficiency, which is our goal, not just to help people, but to help them, give them a leg up instead of just a handout. But so we'll be co-located in Midtown on Bradford Road, and we'll be retaining our individual identity, but working very closely together because, frankly, we share many clients.
I'm guessing that there's some economies of scale there.
Absolutely, yes.
And if people want to learn more about Good News Outreach, how can they contact you if they know somebody that's in need that might need your services? How can they reach you?
Well, you can certainly go to our website, which is goodnewsoutreach.org, or you can call our office directly at 850-412-0016.
Well, we really appreciate you being here and appreciate the work that you're doing and wish you the best.
You bet. Thanks, Dan.
Thank you. Thanks for tuning in. I'm your host, Stan Barnes.
And I'm Eddie Hatch.
And as always, if you like what you've heard today, please subscribe to our channel. In addition to our YouTube channel, it's our pleasure to announce that you can now find us on Spotify and Apple Podcasts by searching Barnes Quarterly in an effort to make tuning in as convenient as possible. To all those that are listening, we just want to wish you and your families a happy and safe holiday season and a Merry Christmas. And we will look forward to seeing you in the new year. We hope you've enjoyed this edition of Barnes Quarterly, and as you know, our goal or mission is to provide you with content that's applicable to your financial situation that you would find helpful in your financial planning efforts. We want to know what you'd like for us to discuss in future podcasts. That can be done by visiting our website at www.barnescapgroup.com. That's BARNESCAP group.com. Giving us a phone call at 850-894-2930, or just leave us a comment below.
There is no assurance that the techniques and strategies discussed are suitable for all investors or will yield positive outcomes. The purchase of certain securities may be required to affect some of the strategies. Investing involves risk, including possible loss of principal. The economic forecast set forth in this material may not develop as predicted, and there can be no guarantee that strategies promoted will be successful. Dollar cost averaging involves continuous investment in securities regardless of fluctuation in price levels of such securities. An investor should consider their ability to continue purchasing through fluctuating price levels. Such a plan does not assure a profit and does not protect against loss in declining markets. This material contains only general descriptions regarding insurance needs and products. This content is not a solicitation to buy, sell, or replace any existing policy. Please speak to a financial professional regarding your specific insurance needs prior to taking any actions. All performance referencing is historical and no guarantee of future results. The opinions voiced in this show are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which investments may be appropriate for you, consult your attorney, accountant, and financial advisor or tax advisor prior to investing. Securities offered through LPL Financial, member FINRA SIPC. Investment advice offered through Independent Advisor Alliance, a registered investment advisor. IAA and Barnes Capital Group are separate entities from LPL Financial.